the answer to your question is I'm much more interested in it than I've been in trying to pick some shorts for, quite a long time.
Thanks for joining us for part 2 of our interview with market analyst and experienced short seller Bill Fleckenstein. If you haven't yet watched part 1 of our discussion with Bill, in which he outlined his rationale for why a revolt in the bond market will likely be the pin that bursts the bubble in financial assets, head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment perspective that Bill and I, as well as our partners at New Harbor Financial, share in this video. And please take just a moment to support this channel by first liking this video and then clicking the red subscribe button below, as well as that little bell icon right next to it. Doing so will help this video reach a lot more viewers. Okay, let's get started watching part 2 of our interview with Bill Fleckenstein. You have a history as a short seller in your career. The last time you and I talked, I asked you, and this was back in April, if it was, if you were thinking of shorting the market at that time, and you said no. One, because you hadn't seen the signs of trouble in the bond market that you were, thinking were kind of an essential part of the mix. And even though you were suspicious of the fact that prices weren't going to be able to sustain forever at these prices, you kind of used an analogy. I don't know if you use these words, but this is what I took away from it. It's sort of like, mortally wounding an elephant, right? You can shoot the elephant and that injury is going to kill it, but that elephant can run around for a long time and trample a lot of people before he actually keels over. And so I think we're wisely saying, I'm not going to get in front of this thing yet until things look a lot shakier. And history has shown that was the right call. Market just powered higher all through last year. Are you now looking at shorting anything here or anytime soon?
I'm thinking very seriously about it. When January started out weak, I thought of my Tokyo analogy I just gave you. And so I put on a decent position, an okay sized position in like ARC. And I had some Apple puts and I had a couple of tech stocks, nothing big, although the ARC position is pretty good. I had some decent Microsoft Apple puts. And then in the break, or was it last week or the week before, I took them all off because I thought
things were getting oversold in the short term.
Well, no, I mean, I wasn't sure that Apple would. I wanted to pick on Apple because it was all teed up, and I thought there was a chance they could have trouble in the quarter, which they didn't. But and I was trying to find something where I thought that the put premiums were mispriced, so that if I bought a little time, that way I could make some money on the premium expansion, even if I got the idea wrong. And I wound up making an okay amount of money. And in fact, Apple made the quarter, and if I hadn't gotten out of the way, I would have given it all back. So I got a little bit lucky there. But the way the market traded, I thought if they hadn't have been able to turn it around late last week, I thought it could have really gotten blasted. If Apple would have come in with a terrible quarter, I think we could have had a big wipeout. So I'm kind of on red alert. I kind of want to see how the next, week or two plays out. I mean, do we get back to business as usual, or do we start to sputter? As I say, the average stock's been going down for 9 months. And the high flyers got drilled. And all of those things are potentially early indications of a beginning of a bear market. And my old checklist for what I would need to be able to be short is all flashing green, right? The Fed's no longer friendly, although they're still printing money, so that's kind of iffy. But the stock market's not hitting new highs. Individual companies aren't hitting new highs for the most part. Stocks are going down on bad news. There's catalysts. So the things that I used to look for as a small checklist as to whether or not it was interesting to be short are all starting to line up. So I'm kind of curious to see how this rally develops, and depending on how it does, how it unfolds, I might start looking for opportunities to be more aggressive on the short side. I don't know how far I will go because, again, this is all pretty theoretical. We don't, again, it's all about managing the risk on the short side. And so when you don't have any data about what QE looks like, and we have all the squirreliness in the tape that I talked about, it's hard to have big positions and manage your risk. So we'll just have to see how it develops. I mean, maybe you'll only be able to get a little bit of exposure. I don't know. But the answer to your question is, I'm much more interested in it than I've been in trying to pick some shorts for, quite a long time.
Okay, well, that's a big statement because, like I said, I mean, you probably best known for or one of the ways you're best known is for your days as a short seller. And the fact that you've kind of been on the beach for a while and are now getting back in, I think it's an important signal. But correct me if I'm wrong. It sounds like you're kind of nibbling at this point.
Yeah,
this
and
is not a
I would
whole hog
never,
moment.
I would never try to start a short fund again because I don't think I could. I mean, again, managing the risk. I mean, how do you have positions on that are meaningful, but be able to manage the risk with all the crazy stuff that's going on? I mean, it's one thing to do it for myself and some friends, but I don't know how you would do this on an institutional level. Now, maybe the market will get to a point where it'll be easy to see that and it'll work. But I mean, I think it's a tall order.
Okay, I totally get that. But here comes the question. So we got a ton of people who watch these videos because they're trying to figure out, how do I navigate my own portfolio as a small fish through all of this?
Yeah.
Not asking for, personal financial advice or anything here, but what kind of general recommendations do you have for those people to consider? I mean, are there asset classes that you think will do better this year, or investing strategies you think that are wise to consider given the uncertainty and volatility now?
Well, the problem is that the obvious safe risk, low nominal risk choice, cash or short dated bonds, for sure you're going to get cheated by inflation. No ifs, ands, and buts about it. If that happens to be true, given the multiples in stocks, I mean, stocks really can't do well either. I mean, so I think the bond market has huge risk and the stock market has huge risk. So what you would say, well, I should hold some cash. Well, yeah, except for you're going to get cheated in the cash too. So it's kind of tricky. I mean, I think that people have to think about, if you have a portfolio, you have to think what ones might be most vulnerable if some of these things play out in a way that I might have said that resonated with them personally. And I feel more comfortable owning precious metals and a handful of the mining companies, because I feel like the inflation that we're experiencing, the inflation happened, but none of the negative consequences of inflation have happened. Last year, the bond market didn't get hit because of inflation. It's backed up because we're guessing, but it looks like it was backing up because of the Fed hiking rates. PE multiples didn't get compressed due to inflation. The businesses in the market didn't get sorted out by, well, who would be beneficial in an inflationary period and who would be hurt? I mean, yes, fast growers can win in any kind of a period, and precious metals never did anything. So it looks to me like getting the consequences of inflation have yet to play out. And if that's the case, then I still believe there's going to be a big opportunity in precious metals and these mining stocks. Now, anyone who's been around them for a year knows that they've gone sideways at best and down more easily, and people are very frustrated. And but if you're going to hold cash, if you say, you know what, I think that's right, I can't hold these bonds, or I need to sell some of my bonds, and I can't own as many stocks, and I'm going to hold some cash, then you have to have something that will protect you from an inflation standpoint. So then if you have some cash and you have some gold or silver and some miners to protect you, and in the overall scheme of things, if the part that's in the inflation beneficiary doesn't work, that means your other stuff probably did. And if that stuff doesn't work, then you've got to have enough stuff over here to help offset the losses you have over there. So you have to look at it from a big picture standpoint. Depending on how experienced you are and how well you can do it, you can run big positions in these metals. But we got to remember, the bigger the positions, the more it goes from being an investment to a speculation. And you have to manage your risk differently with something that's an investment as opposed to a speculation. So there's all kinds of things you got to think about. But I mean, I don't see how you can be fully exposed to stocks and bonds here. So that means you got to have, depending on how you feel, you've got to have some cash to offset that risk. And then you've got to have some inflation protection to offset the high probability that we're going to have more inflation than everyone thinks. And no one's gotten around to putting in the investments they need to protect them from the inflation that I think we're going to have. So I think that's all still in front of us.
Okay, that's great. As you may or may not know, we have talked about the precious metals and the mining stocks on this program a lot as of late. There's a lot of people like yourself, some who have followed precious metals forever, some that are just coming to it now. But there does seem to be kind of a really nice growing consensus amongst analysts of your caliber that there's good opportunity there, or at least relative value given today's high overpriced stocks and stuff like that. You're making me remember when you and I talked back in April, you had also said you were favorable on the mining companies. We weren't really talking about inflation back then because it hadn't really kicked off yet. But I do remember you saying one of the reasons why you were so attracted to the industry was that it had really cleaned itself up. You had companies that were, now strong balance sheets, high positive cash flows. And I remember you saying, and one of the reasons you loved buying them right now is you could buy into them at valuation multiples that were like comparable what the market offered back in the 80s,
yeah.
which you can't find anywhere else now because PEs and all other ratios are blown to the moon. Are those valuations still that good in the industry right now? In the mining industry?
It's really obvious with some companies. It's not quite so obvious with others. It depends on how badly they got impacted by COVID and the disruptions. So some mining entities had a much bigger impact with their employees and having to shut down mills, mines, or because of COVID. And so some of the companies' numbers that they put out in 21 weren't as good as I would have expected given the price of the metals because of that. Having said that, one of my favorites is a company called Westdome, and it's a Canadian company. And they grew reserves. They restarted a mine. They drilled in a mine that had been shut, and now they're going to restart it. And they found a lot more ore in another one. My point is, they had a tremendous amount of success finding incredibly rich ore bodies right where they were already, and they managed to do all this without selling any shares. And the stock's at $8 or so. And I think a very credible estimate that I've seen a couple of estimates that seem credible to me, that they could earn between $1 and $1.25 this year. They've got built-in growth because of what they've got in their own properties. They're in a safe jurisdiction, i.e. Canada, and they've got plenty to drill, and their reserve growth has been strong, and yet you can pay less than 8 times earnings for it.
All right.
There's other examples like that.
I know. I want to just pick your brain. We should have you back on just to talk about mining stocks. I do that with Jeff Clark, who's a mining stock analyst for goldsilver.com. By the way, folks, we have a video coming up with Jeff that he just did for our recent conference, where he went through his latest mining stock picks. So keep your eyes on this channel. That'll be coming out probably in the next week or two. All right, Bill. Well, look, thanks so much. As we wrap up here, for people that have really enjoyed this discussion and want to follow you in your work, where should they go?
Well, if you just want to see my occasional pontification, I'm on Twitter. My handle is @FleckCap. And then I have a website where I write a daily column and I answer questions. I've been doing this since 1996, although I've only had my own site since 2003. That's fleckensteincapital.com. It's a pay site, but I try to price it super cheap so anyone who wanted to could afford it. It's about $10 a month. So if you want to know what I think, those are 2 ways to find out what I'm thinking.
Great. Well, when we edit this, we'll put the URLs up for that, but I will underscore for folks. You should follow Bill on Twitter. I do, and he's got a lot of pearls he just puts out there for free. But I'll tell you, $10 a month for being able to crawl in the brain of a highly seasoned, longtime investor like Bill is the deal of the century there, even better than the mining stocks. All right, Bill. Well, look, really appreciate you coming on. I hope to have you back on again later on this year. Hopefully, I'm going to say with some trepidation, if we see some of the further signposts that you were worried about come
if
to
it
pass.
looks like I said anything that was halfway correct, I'll come back.
All right. Well, thanks so much for coming on, Bill. Really appreciate it.
Okay, my pleasure.
All right, and now's the time in the program where we bring in the lead partners from New Harbor Financial, one of Wealthion's endorsed financial advisory firms. They're going to react to what Bill said, and we'll talk about what the markets have done in the past week. Mike and John, thanks for joining me. Mike, why don't we start with you? What's your reaction to what Bill had to say?
Thanks, Adam. Good talk. Really enjoyed it. Bill talked a lot about the Fed, and says the Fed has basically spoiled us. That we've got spoiled thinking that stocks only go up, that there is no risk, and so they have inflated this massive bubble. And in his words, he says that the economy gets dragged around by these bubbles. It's true, and it's really a brute force method, and it's got a lot of danger to it, in our opinion. The economy, as measured by GDP, is around $20 trillion in the US, in the United States, and the stock market is closer to almost $50 trillion. So, the stock market divided by the size of the economy is over 200%, which is all-time highs. That's the Buffett indicator, stock market capitalization divided by GDP. And so if we actually have a reversion of the stock market to the economy, you're looking at about a $30 trillion difference. And that would only to bring us back to 100%, which is a previous measure of what a bubble has been. So it's a really dangerous spot. And Bill talks a lot about how there's likely to be consequences, to think that you can do so much money printing for so long. I mean, he talked something about $30 trillion of money printing still going on. I think it's actually closer. It's actually much higher than that still. As of last month, I think it was still at a run rate of 120 trillion, regardless of what it is this very month.
But we know.
Oh, yeah, I'm sorry. I said trillion, billion, of course. But yeah, what's the difference? They're both real money. We're just so used to big numbers now that they're easy to mix up. But there's consequences of printing all these billions every single month. So, and he furthermore says the stock market probably won't let the Fed be gradual about their tapering, coming down off that $120 billion a month. And they're going to have to either break the stock market or let inflation go crazy. So they're going to have to probably allow for a much bigger pullback in the stock market than we've already seen, something in the order of, we saw 10% roughly in the S&P, followed by an extremely fast bounce in the last week and a half. Probably going to need to do more than that to really break the back of inflation. And this is at a time where valuations are at all-time highs. I should say confidence is at all-time highs. And maybe we disagree with some other people out there that think there's a lot of pessimism. We're not seeing pessimism. We're seeing a lot of fear of missing out and euphoria. So I'll stop there and pause.
All right, John, I'm coming to you, but I just want to react to Bill's statement there that Mike rightly is worried about what the stock market might do based upon the Fed's actions here. But Bill was basically saying, look, the Fed they're trapped. They're trapped in a dilemma of their own making, and they either do too little and inflation continues to rage, which creates all sorts of bigger issues, or they tighten too much and they kill the market, and the market kills the economy, right? And so Bill doesn't think they're going to be able to tighten all that much. And at some point, he says that the bond market is going to finally wake up to the fact that the Fed really can't engineer a desired outcome here, and is going to take matters into its own hands. And that's something that I think, as Bill said, the bond investors have largely kind of acted like they've been anesthetized for the past couple of decades because they've just been getting fed lower and lower interest rates, which has been great for bonds. But at some point, he thinks that those old bond vigilantes that we haven't seen forever, may start coming back. And if the bond market takes rates out of the Fed's hands, then it's kind of like Katie bar the door time, correct?
Yeah, and that's correct. And I think Bill touched upon or spoke to a theme there that both with the bond markets and the stock markets, there's to use his words, muscle memory that things never go wrong. And most folks can't be blamed for having that muscle memory because things have been papered over and have been distorted in such a artificial way that the real settling point has been hidden. And any tethering to underlying fundamentals in the economy, the settling point is way off from where we are right now, meaning stock valuations way lower, bond yields way higher. And yeah, something's got to break. I like to simplify things into imagery that even a kid can understand. The carnival game whack-a-mole, right? You cannot keep or kind of a tube that has a leak in it somewhere. You patch one and there's going to be a leak somewhere else. Something's got to give here. And yeah, they are trapped. There is a beast of a asset bubble. There's a beast of inflationary pressures here, and something's got to give. I can't help but think of the political climate in terms of the inflation problem. Certainly even though the Fed is in theory independent, the political environment certainly is pendulum, I think, is swinging to, hey, we got to keep inflation from harming, the 90% or more that don't own assets, or 50% or more, whatever the number is. And I'm reminded of a rather out of touch comment that Jerome Powell had in his presser after last week's Fed meeting, that when asked about the disparate effect or harmful effects of inflation on the populace, he said, rather out of touch, in a rather out of touch fashion, that some people are prone to suffer more, and that just I think there's a political environment here that's got to make that inflation challenge one that can't be just ignored. And the consequence of that is the financial assets that have been the main concern of the Fed, I think, is going to have to take a back seat to that.
All right, and we've got some interesting things going on in the markets actually as we're recording this, which I'll get to in just a moment. Mike, coming back to you, I know you had something that you wanted to mention about the near-term bounce that we've seen in the markets, which you've sort of been tracking on this program a little bit over the past couple of weeks. But beforehand, I want to get your guys' reaction to something else that Bill said, which was, he said that when it comes to inflation, asset price inflation is much more toxic than just cost of living inflation, and cost of living inflation is bad enough by itself. But he basically says it's asset price inflation causes tremendous malinvestment, right? To borrow a term from the Austrians. And it's when that malinvestment basically goes into default or collapses under its own unsustainability, is when there's just tremendous amount of damage done. I recorded a video yesterday with Mike Maloney, where he walked through the charts of the 1929 crash, and it initially actually was quite a big melt up from 1928 to 1929. I think that the Dow doubled basically in that period. Got up to about 330 on the Dow, and then corrected by a gut-wrenching like 23% overnight correction in the entire market. I mean, over the course of like a day or two, maybe 3 days. Then a little bit of a bounce, and then it spent basically the next year continuing to fall and fall and fall and fall. So overall, from peak to trough, it was a 90% correction. And one of the things that was so damaging about it was that sure, everybody that was in the market at the peak lost a ton of their wealth, but even the people that were out of the market and were being quote unquote prudent, once the market had corrected 30% or 50% or 70%, they were putting money back in saying, well, okay, now is the time to buy when all the excesses have been bled out, and I'm buying at bargain prices. And they continued to lose half or more of their investment. It just took everything down with them. This just vortex of value destruction. And that's what can happen in an extreme case of where an asset price bubble bursts. So I think Bill was really onto something here. And I think that sort of underscores a lot of the risk that we've sort of been flagging for people over the years. But of course, as we get to this year, which is a year sort of unlike any other, where finally the Fed's hands being forced by inflation, and we essentially have a lot more pins circulating that could puncture the asset price bubble that we've been living with, I think this risk becomes a lot higher even than it's been in the past. So anyways, Mike, with that observation, let me hand it back to you.
Yeah, a number of different things I'd like to point out there. Yeah, I think it's the perfect storm. I think it has the potential to be very destructive. You're right. 1929, the market lost a lot very quickly. It was very close to 50% in about 2 months before the first big bounce, and then ultimately went down 90%. And we don't know the path that this is going to take, but we can tell you that the stock market is more overvalued by far than it was in 1929. Right now, the stock market is overvalued by a lot compared to what it was in 1929 at that peak. So, and everyone has been so conditioned to buy the dip. Just look at what the stock market did in the last 8 days or so. It's been an absolute vertical rip off those lows. It's something I want to talk about. The conditioning to buy the dip has been so deeply ingrained. That is what is likely to be very, very destructive on the way down. If we have a reversion to any sort of mean from these levels, then the tendency is going to be to buy them. And psychologically, it's very difficult not to just buy more and more and more and more as it goes further. And particularly if the same tools that brought us out of the depths last time don't work this time, then of course it could accelerate and panic can ensue. And then lastly, you can end up with an L-shaped move that keeps you down at those depths for a bunch of years until, you know, the damage really sets in. And then it's very difficult to reverse. There's not a lot of great answers on how to deal with that. I mean, one would be just to buy and hold the market like so many do and resolve to yourself that you're just going to stay with that through thick and thin. I think that's okay as long as you realize the allocation that you've got today and what the likely drawdowns can be. We could easily lose 2/3 of market cap in this market and still not be very undervalued based on where we're at. So a strategy that would work probably is layering in, maybe using options to hedge, selling premium, using options, which would basically get you paid for time as volatility expands. Those are some difficult strategies that I wouldn't suggest you go out and try if you don't already know how to do it, but talk to an advisor or things like that. And that's probably going to be what works during that kind of market environment. I'd like to say just a couple other things. We saw a very quick retreat from the high in January. And so it was a pretty deep pullback, but the bounce back was very quick as well. I mean, we just had a face ripper rally the last week and a half or so, but yet it may have peaked today. Who knows? After hours, we got some bad reports from some big tech giants. I think Facebook had a disappointing quarter and the futures have reversed after the market closed. And we had a 62% retracement of that drop. Very, very quick. That's a very common retracement number, a Fibonacci number. We could very well be turning over right now, right as confidence is hitting its zenith. So I'd be really careful. And the last thing I'd like to say is about gold. We talk almost every week about gold, and gold really seemed to have wanted to break out to the upside out of its bullish triangle and did hit 1850 and then quickly dropped about 70 points to 1780. So that was disappointing to see. We're back up about 1810. So jury's out. We're inching towards the top end of that triangle again. I still think it's going to break out to the upside and that it's trying to shake people loose. But those are the things we're looking at right now.
All right, thanks. Real quick, just on gold, I just want to underscore the fact that Bill Fleckenstein, yet again, another analyst who's, looks at the entire market, but still comes to the conclusion that gold and the miners are still one of the best places to park capital right now. I mean, otherwise, he was basically saying, start to draw down your capital that's in stocks and bonds, et cetera, and traditional investments, with the exception there of miners. So getting to your point about what's happening in the after hours. So, as we talked about, and I talked about in a few other videos in the past week, it certainly looked like we were overdue for some sort of market relief rally here. And boy, did we ever get it, right? As you said, it was a face ripper, but relatively quick. It's only been over past couple of trading days, but it's been very extreme. But now we're seeing something really interesting. This isn't just going from oversold to overbought and correcting. This is much more structural disappointment. And this is breaking news when we're seeing it. It'll probably be a little bit digested in the media by the time folks watch this video. but Facebook just disappointed on its guidance, and I think disappointed on some of its numbers and its forward guidance, but it's down like 22% right now. Did a quick look online. I think Facebook's, was before this close to $1 trillion market cap company. That's $200 billion in market value just gone in a heartbeat, just poof, right? We're seeing the same thing across other tech names. I know PayPal, Snap, a few others are down 20+%. John, I think you mentioned a few other names right before we hopped on here. But this goes to show how quickly, when you have a market that's this overstretched in terms of valuations, how quickly a correction can happen, right? There's a lot of people that are going to wake up tomorrow who maybe bought those stocks today during the trading day. You're going to find that they're 20% plus, underwater the next day after, right? I mean, there was no time for these folks to react. They literally, logged off at the end of business and logged back on tomorrow. They're going to be, only 80% as wealthy as they were the day before. So one of those key elements to, make sure that you're positioned for trouble in advance of trouble, and employ a lot of the risk management safeguards, the hedges, et cetera, that the guys at New Harbor have been talking about forever on this channel. John, let me just hand it back to you because you watch the tape even more closely than I. What is this signaling to you here when you see drops this extreme across this many big players in the space, especially a lot of players that were darlings up until 40 minutes ago?
Yeah, Adam, I think it speaks to a bigger thing and a bigger paradigm shift, regime change, if you will. And this was talked about at the Wealthion conference that we helped you co-host. I think it was last weekend, losing track of the dates here. But this concept of going from stability and calm to heightened volatility, instability, a system when it becomes unstable starts to move unstably by definition. The recent balance, I just want to make a couple comments there. Things like this, the short-term moves like we've seen there, in a sense, are highly predictable. And we talked about it with you, and you've had other folks talk about some of the technical indicators. For example, the markets had gotten deeply oversold on a short-term basis. If you look at things like moving averages, 50-day moving averages, and standard deviations around that, we were outside 2 standard deviations of that moving average, and we were sitting on support that was technical support that dated back to last October. So it was logical from a technical standpoint that there would be a programmatic, if you will, bounce. And as Mike said, we've retraced 62, 0.3, I think it is, whatever the Fibonacci level is. That's very common, and from a programmatic standpoint, it just happens to also be right around the 50-day moving average. So from a short-term, programmatic, machine-driven technical things, this is all very kind of almost expected, but focusing on that stuff can lose sight of the bigger picture, which is we are tremendously overvalued, very unstable. We're seeing some misses like we just talked about there. The comment about that Mike Maloney talked about with the 1929 market, we can go even more recently to the tech bubble of 2000. And we talked about this after the last video we did, Adam. You look at the tech bubble 2000, the market rose 80%. The NASDAQ rose 80% between October 1999 and April 2000. That's a small handful of months, 6 or 7 months, 80% rise. But then it dropped 80% from there until the ultimate market low in 2002. Now, simple math, and this is the thing that I think many folks misunderstand. Oh yeah, I went up 80% and then I lost 80%. Well, big deal. I didn't make any money, but it was fun. I had a 0% return. That's not how cumulative returns or compounding returns work. That 80% plus followed by an 80% decline actually translates to a 65% cumulative net loss for that round trip. And I see it all the time on Twitter and just layperson's comments that, well, if I, go up, 50%, I lose 30, I'm still up 20%. No, that's not how it works. Do the math. And that's one of the big misunderstandings that leads to complacency. I can tell you, we talk to clients all day long, and yes, there is a fear of missing out. But when we put things in perspective, very few of our clients actually want to try to play this short-term game, the short-term bounce, because they know when we illuminate the data that it really would feel really horrible, to put it lightly, that their hard-earned savings was put at risk in what categorically is the biggest bubble of all time, simply trying to scrape some nickels out of a very late stage unstable market.
All right. Well said, John. And you were talking about some technical indicators earlier on. I just want to talk about a fundamental one for a moment here. In PayPal, which got hammered today, the headline there is PayPal warns that consumer spending is about to fall sharply. And just reading here from this article, Omicron, inflation, and lack of government stimulus have some Venmo users nervous about spending money from their digital wallets. That's bad news for Venmo owner PayPal and a potential warning sign for consumer spending in general. And this is something that we, and I've had a couple of videos dedicated to this. With the expiration of all of the extraordinary pandemic stimulus that was going directly to households, either as direct checks or extended unemployment benefits or childcare benefits, there was an awful lot of money getting pumped into households starting middle of 2020, largely sort of through the end of last year. There's even a few little dribs and drabs still in the system at this point, but the key thing is that spigot's been turned off. And as you might expect, all of a sudden consumer spending is getting hit by that, right? There's just a less discretionary capital out there for folks to spend, and that is deflationary. And that will likely translate into lower revenues and lower profit margins for a lot of companies as a result. And we're potentially beginning to see the first of that right here. So I just want to make note of this milestone, because this may be not a one-off thing that we hear in the media. We might actually start hearing this a lot going forward as we move further and further into this year. And of course, the Atlanta Fed GDP, their forecast for Q1, they just started publishing that last week. I put the chart up in a couple of previous videos, but that's right now at 0.1% GDP growth. I mean, that's basically economic stagnation. So unless something changes there pretty materially, we're seeing a very sharp slowdown in economic growth already in 2022. Q4 2021 came in at 6.5%. Now it's basically zero. So, very interesting times ahead here as we are seeing this sharp slowdown in economic growth. The Fed is, planning on tightening interest rates. We have increased volatility in the markets. We're seeing some massive drawdowns, like the type we're talking about today, in the stocks that have powered the market higher up until now. So, all of a sudden, folks, this is really becoming a ball game that could go anywhere. Boy, Mike and John, I'll let you guys have the last word. But from my perspective, unless you are a highly confident and highly active, day trader, practically, I think this is a time for really prioritizing safety, because nobody knows what's going to happen next. And there's just so many risks out there, given the instability of this market, risks to the downside here, that this is one of those years where it probably makes sense to prioritize just getting through it as intact as possible, as opposed to trying to, aggressively strive for gains. But I'll let you guys have the last word. Mike, why don't we start with you?
Yeah, I mean, this is the time for capital preservation, Adam. Maybe that we get a melt up in the market. Who knows? I can only say that we're at the most severely overvalued place ever, by far. And if we do get a further melt up from here, it'll only be followed by more devastation. So, our advice to people is to raise cash, reduce equity, get your stocks down to something palatable that you can sit through no matter what happens. 30% or less is a good target. And, as John said, we're noticing a phase change in the markets. They're getting more volatile. That's usually a precursor to something different. So buckle up, get safe, and wait.
All right, John.
I don't have too much to add. Enjoy life. Take a step back and know that everything's not bad. Things get better. Markets get better. Investment opportunities get better. Just the trick is being selective and patient, waiting for those better opportunities.
All right, good perspective. And, I just want to underscore, because I've seen it happen before, in the years that we've been doing this, guys, where when there is a swift market correction, the people who were intending to take, action beforehand, but didn't, they all of a sudden come spilling out of the woodwork, saying, oh, I really should have done this last week, but oh, God, what can I do this week, right? And I just want to underscore for folks that, your destiny tomorrow will be highly determined by the action you take today. So when it comes to the safety of your capital and your wealth, really don't delay, right? Whatever you decide are the right steps to take them now. If you have not yet had a free consultation with a Wealthion endorsed financial advisor, they're free. They don't cost you anything. There's no pressure, no expectation or commitment that you have to work with these guys. It's really just offered as a public service to give you feedback on how your investments are currently deployed and ideas on what you could do to, basically increase your both upside potential, but more importantly, your limit your downside potential. If you want to have that discussion, John and Mike and their team offer it, as do some of our other advisors. Just stick around to the end of this video. It's coming up in about 30 seconds. We tell you how to do that. It's really easy. It only takes a couple of seconds to set up a consultation. With that, if you are enjoying great discussions like this, like we've just had with Bill Fleckenstein, please help us get more guests like him in the future by supporting this channel. To do that, all you got to do is just like this video. And if you haven't already, subscribe to this channel by clicking on the subscribe button below, as well as that little bell icon right next to it. And guys, no matter what happens from here, we will be tracking it together every week. Thanks for coming on for this week, and look forward to doing this all again with you guys next week around. John and Mike, thanks for piping in here. Everybody else, thanks for watching.
Thanks, Adam. Look forward to next week.
Great talk this week, Adam. Enjoyed it. See you next week.
If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to wealthion.com. These consultations are completely free, and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, "Don't worry, the market will always take care of you." For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the Wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.